Okay, folks, we have the gold market. This is a 4-hour chart. And this past week when we did live sessions, I gave you a very clear, easy condition, stage, execution format for using the information I've taught you this entire 12 months. And I was asked to do gold, and we went through the monthly and we went through the daily, and I'll let you watch the recordings this week. It was actually done on August 23rd, so if you want to watch the recording, it's usually found around the 1 hour and 30-minute mark of part 2, if I'm not mistaken. Part 2, 1 hour and 30 minutes. You'll hear me go over the breakdown on gold. So we're going to look at the gold market here. And at the time of the recording, we were looking for the outline of it being bullish. So I'm going to frame here's the beginning of the 23rd. And we were outlining the fact that the market has to trade lower for us to pick up a discount array. And we had a low here, and we had a low here. So we're going to outline this. Here we have a low here. And we have to see price trade down to a discount. We can't trade it going long while it's going up on our 4-hour if our time frame is looking for a discount. So we have to wait for it to trade lower. So we're going to go down to an hourly chart and use this reference point right here. Go down to an hourly. Okay, and so now on an hourly chart, we have this low, and now we have this gap right here. Only the buy side was offered here. No sell side delivery was offered here. So we're going to put our horizontal line here. Okay, so we have only an area or range where buy side was offered. So between 1280 and 1278. Okay, two handles, only buy side offered. Prior to this gap, what's the next downside discount array? It's this high here. So if price was given up all this range and went lower, the first one it comes to is going to be this swing high or this swing high. We're going to use this swing high. It's the higher. It's a swing high because it has a lower high to the left and a lower high to the right. And the next one below that would be here. So it would be discount array here, then another discount array here, then the order block in here. All moving away and below that fair value gap. So we're using PD array matrix here. And now we're going to use this. Our stop would have to be below this level. So we're going to make this red and we're going to thicken it up a little bit. Well, not with that, we'll put it right here. So we identify a discount array we're trying to buy at, and we protect it with a stop below the next discount array, which is here. So our stop needs to be below 1276, and this whole candle, its low is a little bit below that. So in this instance, we have to go below it. So the candle we create the premium on, it's all one candle. We don't want to see it spike down through that. So the next discount array would be this one here. So its high is 1275. So I would refine my stop level to this. It's got to be 1275 and below. So we could be a buyer down here if it comes down and fills the gap, and our protected stop has to be below 1275. So we'll use 1274. Okay, protective stop. Entry is in here. It would be a run on sell stops and trading on external range liquidity for this low, but internal range liquidity for this low to this high. So we have to be a buyer at discount, and we're going to look to pair that up with a premium array. So we have to see it trade down below this low. That would be an external range liquidity run, and we could couple that with an internal range liquidity run here. So we have a low up to high, and you see me do this in the live session, and that gives us optimal trade entry right down here. Here's the 70.5 level, 79 retracement level, and our stop's going to have to be below that. But the fair value gap is here. So we have this area. 62. Down to 79 right here. And the sweet spot of that is here. So we're going to say this is the actual entry with the overlap of 70.5 because it could spread just past the gap. Or we can do 78 and that closes the gap, and we may allow the spreading to the 70.5 level or sweet spot optimal trade entry. So we're looking to go long at 1278 and stop is 1274, and we'll be looking for any premium array, but we have to look at it after the market starts to trade down. So here's our low. We wanted to see it go down into the fair value gap, but it didn't do that. So what did it do? It stopped short. Now we're rallying up. Are we buying it here? No, we're not. Price goes up, closes in a fair value gap here, right in here, and let's see if it starts to sell off. Trades down and then sells off. Trades back up into short-term high. The whole time we have the plan of buying down here. Here's the fair value gap. So we're going to take this and just scoot this on over here a little bit. There you go, just like that. And the stop level here. Okay, and price hits 1290 in here. Bearish order block, runs a short-term high. Right in here, it spikes up first, runs the highs, runs these highs, trades down into the gap. So we go long at 1278, protect the stop, 1274, never hit, pick up a discount array, buying sell stops below these lows and here. Price rallies up immediately back up, and this is where we're sitting at now. So now looking at price, if we miss this opportunity, like some of you most likely did, we can now use the breaker to get long. Now the question is where is the breaker? We have this high prior to this low. We have this in here, but it's not as defined, and it's this one here is lower than this one, and we've traded above this high. So now what I would err on is I would say these candles here are going to be the breaker. So as long as we're buying inside this range, extended in time, this could be a good area to be a buyer for gold. So we could see it pick up and rally again. Using what I've taught you, in this example here, we talked about this in advance. So when I was questioned, it literally took me